let's talk about your latest launch, the VanEck Onchain Economy ETF, which seems really interesting. So do you want to break down the investment thesis for our listeners?
Sure. So what we've observed from talking to clients and potential clients is that many investors are scared away by the volatility of owning crypto directly. They are oftentimes confused about how to value it because there's no stream of cash flows, and they worry about integrating it into their standard workflow in a way that allows them to see the impact of the position on their client portfolios.
Hi and welcome to the Financial Fox, the show where we explore how technology is reshaping finance, unlocking freedom, and helping us to invest smarter. I'm your host, Steffi. I've spent over a decade in the finance world and started investing in crypto back in 2017, when it was still a wild frontier indeed. On this show, we go beyond the headlines, having real conversation with forward-thinking leaders to spark new ideas and give you insights that actually matter. Today, I will be joined by Matthew Sigel, Head of Digital Assets Research at VanEck. You might know VanEck has long been known as a pioneer in alternative investment, always one step ahead, from commodities ETF to crypto. We'll be talking about why alternative assets are more important than ever in today's volatile environment, about VanEck's latest ETF node, about Bitcoin in corporate balance sheet, and also about the intersection of digital assets and AI infrastructure. This show is supported by HIVE Digital Technologies, and more about them later in the show. Now, a couple of things before we get into it. If you are watching our interview, please take a moment to subscribe to our YouTube channel and follow Financial Fox on social media if you haven't done so already. You will find all the links in the descriptions. Remember, your support is crucial to grow the channel so we can educate more people about crypto. And please remember that the content on the show is for informational purposes only and not intended as financial advice. Any opinions expressed by me or my guests are ours alone, and you should not act solely on the back of them. As always, do your own research, level up your skills, and be accountable for your own decision. With that being said, let's get Matthew on. Hi Matthew, how are you doing?
Hey Steffi, nice to be with you.
Yeah, it's great to have you on the show. So let's start setting up the scenes a little bit, because I want you to talk more about the new ETF launch that you have coming up on the 14th of May, which I think is quite interesting to see how a pioneer like VanEck is looking at investing in the future. VanEck has always been at the forefront of new asset class, from the gold ETFs to early mover into crypto. So I wanted to ask you why you believe alternative investment is becoming essential, especially, in today's world that is kind of like more volatile than it used to be, rather than being an option for smart investors.
Yeah, I think that VanEck is at our core a macro shop, and many of the new asset classes and products that we've brought to market over the last 7 decades have been a function of, trying to look 5 years into the future and anticipate what types of asset classes are going to be gaining more adoption. And in the case of Bitcoin, we started in 2017, getting conviction that Bitcoin could eventually be a competitor to our significant gold weightings. And then, over the last 5 years, we've brought 25 products to market, and roughly 3% of our assets are now in crypto and digital assets and Bitcoin related products. The CEO, Jan VanEck, has said that number could reach 15% over the next handful of years. And the macro theme that we've latched onto here is a de-dollarization, essentially, fragmentation of global trade, and a distrust of traditional fiat currencies that seem to be kind of combining into a generational preference for Bitcoin and maybe for other hard assets. So that's kind of the underlying thesis for digital assets, specifically Bitcoin, is a lack of trust among some of the traditional institutions, at the same time that emerging market economies are growing faster than developed market economies, and many of them are looking for neutral store of values. So Bitcoin certainly fits that.
Before we dive into today's interview, I'd like to introduce you to our partner, HIVE Digital Technologies, a publicly listed company building the next generation data center infrastructure with 100% renewable energy. HIVE was the first crypto miner to go public and the first one to have an AI strategy. With over 2,600 Bitcoin on their balance sheet and operations in Canada, Sweden, Iceland, and Paraguay, HIVE is fully committed to transforming communities, rebalancing the energy grid, and delivering value to shareholders with a low dilution and cash focus approach. If you don't know HIVE, check them out at HIVEdigitaltechnologies.com. Yeah, 100%. What was the reason why you got into Bitcoin?
Yeah, so this firm was founded in 1955, and the first ever product was a non-US mutual fund. It was a fund that was meant to invest on the back of the Marshall Plan, the rebuilding of Europe after World War II. Actually, this was a rather innovative asset class at the time to be offering a non-US fund. And in the late 60s, the PM of that fund who was John VanEck, the founder of VanEck. He got conviction that inflation was going to accelerate, that the gold peg was at risk, and he pivoted a lot of those non-US holdings into gold mining stocks. It was a bit of style drift. The fund had not yet been renamed into a gold mining fund, but that was a source of incredible outperformance. That mutual fund became the best performing fund in America in the 1970s, and from there we spun off kind of gold-specific mining strategies, physical gold strategies. It's a disproportionately large percentage of our asset base compared to kind of more other traditional asset managers. And because of that, when Bitcoin started to gain prominence, the management here was concerned, but also saw it as an opportunity to diversify some of our gold profits into this new digital gold.
So VanEck's is Bitcoin as mainly digital gold, or there is something beyond that? Because one of the conversation that goes around is like Bitcoin was created as a peer-to-peer cash systems. Obviously, it becomes an asset that has been endorsed by institution and now also nation state as an alternative to gold. But there is much more, because there is all the payments, sound money. There is much more that actually comes from the Bitcoin ecosystem. How are you looking at that?
Maybe as a better form of gold, in the sense that Bitcoin is more divisible, it's more easily transportable. So rather than using gold as collateral to raise fiat debt, which I think many economies do. Many central banks have, say, 15% of their assets are in gold. So implicitly, gold is enabling leverage happening on other parts of their balance sheet. In the case of Bitcoin, maybe it can be used as a medium of exchange more easily, Bitcoin can, than gold. So, for example, the intersection of Bitcoin with energy, many of the countries that have begun mining Bitcoin using government resources over the last year, I'm thinking of Kenya, Ethiopia, Argentina. These countries have deals with the IMF, so they have debt that needs to get rolled over. When you try to roll over debt with the IMF, they often impose a number of conditions. Specifically, they tell countries you have to raise taxes if you want to roll over this loan. Many countries, that causes some domestic political debates that are uncomfortable, that raises issues of self-sovereignty, and Bitcoin can become a handy negotiating tool where a country is able to immediately monetize some of their stranded energy into hard currency without necessarily borrowing from foreign lenders. So that intersection between energy and Bitcoin is unique, as you know. The proof of stake coins don't have this dynamic. And now as AI begins to grow, many are realizing there's this natural intersection between Bitcoin and AI because of the energy intensity. So the way that Russia is approaching their Bitcoin infrastructure, they've announced that their sovereign wealth fund will seed a number of investments in the region to build both Bitcoin and AI infrastructure. And that's where we see kind of the US regulatory pivot as very important. When President Trump talks about Bitcoin, he often mentions AI and energy in the same conversation. And that direct linkage, when you look at gold mining stocks, they do move on energy prices because diesel is a primary input into digging the gold out of the ground. But the transmission mechanism between energy and Bitcoin is even tighter, in our opinion.
Yeah, well, one of the definition of Bitcoin is energy-backed currency, right? Or energy-backed money. Now, as the gold price goes up, how do you see the impact in Bitcoin, or with your Bitcoin app, how do you consider this kind of increasing of gold price?
There's many instances in the past where a Bitcoin rally followed a gold rally. So on a day-to-day basis, the correlation between the two is not particularly high, but over longer periods of time, gold sometimes moves first and then Bitcoin catches up, or vice versa. So we think that the recent gold rally has legitimized this narrative around de-dollarization. We can observe that much of the gold rally was happening during the Asian trading hours, which is kind of anecdotal evidence that there's some repositioning going on at the government level, perhaps. And Bitcoin also throughout April kind of rallied stronger during those Asian hours. So I think it's some of the same underlying forces that drive the two, but they're not necessarily correlated on a daily basis.
Okay, let's talk about your latest launch, the VanEck Onchain Economy ETF, which seems really interesting. So, do you want to break down the investment thesis for our listeners?
Sure. So what we've observed from talking to clients and potential clients is that many investors are scared away by the volatility of owning crypto directly. They are oftentimes confused about how to value it because there's no stream of cash flows, and they worry about integrating it into their standard workflow in a way that allows them to see the impact of the position on their client portfolios. So the ETFs solved maybe 1/3 of that, in the sense that you can own the ETFs in your traditional brokerage account, and that's at a very low cost. So that's super handy for a financial advisor who wants to control all aspects of his clients or her clients' assets. What the Bitcoin ETF doesn't quite solve for is that traditional cash flows, and some folks, when you ask people why haven't they invested in crypto, the volatility really is usually the number one answer. So our idea with this strategy is to widen the investment universe, not limit ourselves just to companies that are pure plays in crypto and Bitcoin, where the universe is actually quite small. We do have a product that buys only pure plays, companies that are deriving more than half of their revenues from Bitcoin or digital assets. It's a very concentrated portfolio. There's only 22 stocks, and the vast majority are kind of Coinbase, MicroStrategy, and Bitcoin miners. These are all names that have volatility actually quite a bit higher than Bitcoin itself because they're leveraged to the space. They often have debt. So our idea with this new product is if we take an investable universe of any company that has a credible strategy to participate in the on-chain economy, of course that includes the pure plays, but it also includes firms that are selling infrastructure, energy, TradFi rails into the crypto economy. You end up with 130 plus names, more than $8 trillion of market cap, so 3 times the size of the crypto market. And many of these names have much lower beta to Bitcoin, although it's growing, and they provide diversification. So we think we're going to be able to own every sector in the S&P, all 10 sectors. We can find firms that have some exposure to Bitcoin and crypto, and particularly on that infrastructure and energy infrastructure side. The utilities, the midstream energy firms, they're increasingly calling out Bitcoin and crypto as a driver of their end market, but the volatility of those stocks is dramatically different. They're often thought about defensive stocks, actually. But now, if we think about that intersection of AI and Bitcoin and energy independence, there's a whiff of kind of a pro-growth story here that we think is going to benefit some of these utilities, but with much lower levels of volatility. And so packaging all those equities together, we think will yield a differentiated strategy in terms of risk and return.
I just wanted to understand how you think about infrastructure, because obviously it's a big part of your investment strategy. And, if we look at what's happened with DeepSeek in China, we are seeing, different ways to look at infrastructure. And I just wanted to understand how you think about it and why it's so critical right now.
Sure. I mean, it's really as simple as a shortage of data center capacity here in the US to service the AI opportunity. And it turns out that the listed Bitcoin miners control a pretty material amount of that data center capacity, which could be repurposed to serve the AI market. A number of miners have pivoted a portion of their capacity to serve that market, but it's not so simple as just flipping a switch. There's a lot of additional equipment and redundant energy that needs to be put into place before a Bitcoin miner can serve the AI or high performance computing markets. And so you've got a value chain there, whether it's diesel generators, cooling equipment, or like the natural gas or the coal or the nuclear energy itself to power these data centers. And so I think you should think of it on the infrastructure side that perhaps we'd be more inclined to own data centers that have kind of this dual purpose of serving both AI and Bitcoin. They're both very nascent markets, growing very quickly, but very volatile. So when you combine two volatile end markets together, maybe you can smooth out the volatility of the revenue and income. That in turn becomes more attractive to a financier, a financial institution who wants to lend or provide capital into these data centers. And so the cost of capital goes down and the stock price goes up. That's kind of what we saw from Core Scientific, which was the first Bitcoin miner to really hit the gas on this pivot. And we'd expect that within reason to continue. So that would be one kind of major segment within the infrastructure is the data center infrastructure. And then another would be literally the electrons. Which utilities are most friendly to Bitcoin miners? Which utilities are calling out in their public filings or conference calls or investor relations materials that Bitcoin miners and crypto are actually moving the needle in terms of the electrons being delivered and their growth outlooks. And there's a number of companies that are doing that, which are kind of flying under the radar because they're boring utilities that kind of high growth crypto investors don't typically look at.
It's interesting how you see and how you think about, this dual business model that the Bitcoin miners has got, where they've got data center for Bitcoin mining and data center for AI, and we see a hot hate that actually they look at spinning off one part of the business, and where you are actually thinking that every this duality is actually good for investors.
It's good for investors because the largest single input into a discounted cash flow analysis, where you're trying to literally just figure out what, this company could earn this much in cash flow over the next 10 years, but let's think about the time value of money and provide a present value that takes into account all those future cash flows. The biggest variable for that type of model is the interest rate that you use. So the lower the rate, the higher the stock price. And it turns out that the lenders, the balance sheets who are willing to fund building out these data centers, they're a bit more keen on the AI model than they are on Bitcoin model. So when a Bitcoin miner announces one of these pivots, if it's credible, the analysts usually assume that the company can borrow money at a rate that's more attractive than what Bitcoin miners can borrow at. And it's just that simple tautology of lower discount rate equals higher stock price, all things equal.
Let's talk a little bit about balance sheet of those miners, because one of the things obviously they hodl Bitcoin, and some of them they also follow the MicroStrategy playbook, started to buy more Bitcoin, but then they are obviously raising cash, going back to markets to fund their operations, so they are the stock is quite diluted. So how do you think about the risks and also the opportunity for when you look at the miners that maybe hold Bitcoin, but it keeps go back to the market to maybe with convertible loan notes, and those kind of things could actually put the company more at risks?
Yeah, totally agree with your observation that the companies running levered Bitcoin strategies are more risky and more volatile, and we have to think very carefully about the position sizes for those types of names. When we look back at the last cycle, many of the firms that borrowed money ended up going bankrupt or restructuring. So the pure play Bitcoin miners that really are in a tough spot structurally, just because of the kind of melting ice cube model where their revenues go down by 50% every 4 years. And meanwhile, they have to refresh their Bitcoin mining machines in order to stay competitive. So it's a very capital intensive business where unless the Bitcoin price is going up, you have this natural decay, and they constantly needs to raise capital. So the question is, do you raise it via the debt markets or via the equity markets? I don't sympathize with the decisions that these boards have to make, because if they raise it in the equity markets, then you've got the shareholders who complain about dilution, and if they raise it in the debt market, then you've got people like me saying, hey, watch out, you're going to go bankrupt, don't take on debt. So it's a very tough balance to strike, but all things being equal, the more debt you have, the riskier the enterprise. And that's especially true when your assets are in a very volatile commodity like Bitcoin and your debt is denominated in US dollars.
Do you sell your Bitcoin? That's another option.
Yeah, and I will say in their favor, we just did a deep dive on this in our most recent Bitcoin Chain Check, which is a monthly publication that we put out. Many of the software tools that financial analysts use to look at the financial statements of publicly traded companies. So we use Bloomberg, we use FactSet, there's a number of data providers. They're not accounting for the Bitcoin as a cash or cash equivalent item. And so when you run an analysis of the net debt of these companies, where you're basically subtracting their debt from their liquid assets, many of the Bitcoin miners look like they're net debtors, but once you account for the Bitcoin, they're actually net cash. So now that's only relevant when Bitcoin draws down by, 30, 50, 70%. But I think if some of these companies maybe explained that they would be willing to sell their Bitcoin in order to prevent further share dilution or debt problems in a downdraft, maybe that would give a bit more comfort to the market. Because it does mean that the pure play Bitcoin miner and hodlers, when you look at their beta, either to the S&P or the NASDAQ or even to Bitcoin itself, it's quite high. And that's why above 1, sometimes approaching 2, where the daily moves on these stocks can be 2 times the Bitcoin move. Very hard to achieve a balanced, diversified portfolio with only those types of names.
So it seems like you kind of like the ones that they're actually holding and keep holding of their Bitcoin, right?
It depends how much debt they have on the other side. If you can hold a bunch of Bitcoin and not have a lot of debt, that's a very favorable position. If it's just merely offsetting debt and the market's pricing in that you're going to have to dump it to pay back the debt, if Bitcoin falls 30%, that's a recipe for a very volatile stock.
Now, and talking about that, I just want to move to Bitcoin for corporation, which is becoming now a big trend. Following MicroStrategy and a few other companies in the US, they are adopting this treasury strategy. And this is also an area that you have said that you are going to be looking at for your investment. Now, I wanted to kind of pick your brain on how do you think about the Bitcoin for corporation candidates? So this company buying Bitcoin to put on their balance sheet. Is there kind of like specific profile for those companies that you're saying, okay, a company like that will be a good candidate to follow this strategy if they want? And how are you going to be picking your winners?
Sure. There's a couple of variables. I think one of them is size. We see it in markets generally that the larger the size of something, the smaller the chance it's going to go to zero over your investable time horizon. And so for a name like MicroStrategy, which has 7 or 8 different debt issues in the market, convertible bonds, straight bonds, preferred securities, you've got a number of hedge funds that know the name, are comfortable trading these debt securities and playing around with the volatility and exploiting some of the arbitrage that can occur there. Some of these MicroStrategy debt instruments are now in ETFs that are full of, say, a preferred security ETF, and that makes, I think, the strategy a bit more durable than a brand new company that comes to market holding 100 Bitcoin, has never interacted with some of the brokers that can help place their convertible debt into these hedge funds. It's a riskier strategy, so size is helpful. Another variable would be the valuation. MicroStrategy tends to trade at a premium to the Bitcoin that they hold. In fact, we're tracking 10 or so names that all are kind of Bitcoin hodlers. The stocks tend to trade at between a 20% to 100% premium to their Bitcoin. At 100%, you really start to ask yourself, like, what is the risk reward here? How can that be justified? What other earnings can they earn that's going to make that type of premium justified? But as in a bear market, or even if you have just some idiosyncratic stock movements, sometimes these companies can trade at a discount to the Bitcoin that they hold. We're actually seeing that in one small cap name right now. And so that makes the stocks a bit more interesting, all things equal. So I'd say we're definitely tracking those premiums to the NAV, the net asset value, and looking for the ones that are at a very low premium for no particular reason and trying to figure out how that value could be unlocked.
Interesting. We had recently on the show Michael Moe from Tech, and when I was going through the balance sheet, one of the things that was making me thinking, right, when you have got a company that actually has got increasing revenue, then maybe a Bitcoin strategy could be interesting because first of all, they don't have to sell, they've got the cash they can deploy to that. So it was kind of like natural way maybe to think about a Bitcoin strategy, but then you go out and you see it's become a trend, and there are many other companies they are just buying into without even maybe being able to afford it, right?
Yeah, no, I agree with you that, like, for MicroStrategy, the other thing they have there in their advantage is there's a core business that's generating millions of dollars of cash per year, and so that core business can support some degree of borrowing in the market. And when there's no core business, then you wonder, like, why really is anyone lending them money? What's the hope of getting paid back? And I think that is a big variable to consider. And it's nice when there's a core business to pay back the loans. The other thing to consider now that these names are popping up in so many different markets, a lot of times there's a country-specific tax reason why the equity, all things equal, is more attractive than the Bitcoin itself. And you can see that in Japan. The capital gains on buying Bitcoin can be as high as 55%. It's basically treated as income. So for a high income earner, you could be paying 55% on your Bitcoin gains. The long-term capital gains rate for equities is 20%. So that's a very wide margin. And we think that explains part of why Metaplanet trades at the highest premium of all the Bitcoin hodlers that we're tracking.
That's a very interesting point. I've got a couple of other things I want to ask you. First of all, what about stablecoin in your new ETF?
Well, we are including them in the sense that among the infrastructure category, right? So for this new fund, we're looking at any publicly traded firm that has mentioned digital assets, Bitcoin, crypto, with a credible plan to make money from it. And if you look in the consumer, so we divided this universe into 10 different categories, such as balance sheet hodler, TradFi enabler, miner, data center provider, energy infrastructure. In the consumer segment, you can look at names like Shopify or Mercado Libre, which is a Latin American kind of Web2 giant. Some of these companies are integrating stablecoins into their applications, both for external vendors to access, but also internally to move their own treasury around in a more efficient manner. And we think that, just saving a few basis points on the treasury operations internally can actually flow through to the bottom line. So I think you should expect to see some of those types of names in this strategy as we take a wider view to the on-chain economy, not just thinking about revenue generation, but also about cost savings. I thought you were asking about, like, are we going to bring a stablecoin ETF to market? Because there are now these new, like, T-bills ETFs in the US, which people are kind of laughing about. So we'll see. Stay tuned on that.
Right. Like, last question, sustainability. So we talk about infrastructure, we talk about energy, we talk about, power, we talk about cost also to support this rise of AI and infrastructure to sustain that. How important is to have a strategy focused on sustainability for you as an investor?
Well, I might think about sustainability in a different type of fashion. For me, an organization or an economy is sustainable when it's growing, because when companies, cities, countries start shrinking, that's when human mentality turns into zero-sum mindset, and culture can get very negative, and you end up with like a PvP type of situation rather than a everybody wins. So I think that sustainability is about pro-growth and the ability of an organism or a company or a city to not collapse from entropy. And I think the collapse from entropy becomes more common when things are shrinking. So that's like my number one, is to grow. When you look at the energy intensity of either Bitcoin mining chips or any other industrial equipment, there have been great efficiency gains over the years. We're constantly doing more with less. So I don't get hung up thinking about things like net zero as an example.
Yeah, so it's less about green, it's more about growth. Matthew, thank you so much for coming on the show. For anyone that is interested in knowing more about VanEck, your latest ETF, and would like to get in touch with you, where should I go?
Sure. Yeah. Please follow VanEck_US on Twitter, or Matthew_Sigel. And all the disclosures for this Onchain Economy ETF are up on our profile pages. So you'll be able to read the prospectus and follow us for more information as we announce more details on the investment universe. And the fund should be trading on May 14th.
Yeah, super important. This has never been a financial advice. It's very important to do your own research and get educated and, understand where are you putting your money if you are going to be investing. So that's super important for any investors listening and, as a general good investment practice. Matthew, thank you so much for coming on the show.
Thank you, Steffi.